Good morning. We are Group 1. Today we will be analyzing the balance sheet and cash flow of one of the shipping company, that is NOL, Neptune Orient Lines. NOL are the global transportation company with core business in container transportation and supply chain management. Here we are going to analyze the balance sheet as on 25th December 2009 with the effect of the global economic crisis compounded by factors specific to container shipping, which is NOL's primary business. The year 2009 has been a difficult year for the company's business. As per the analysis of the consolidated balance sheet, total assets and sources have increased by approximately 49%. The debt of the company has decreased from 12.6% to 5.2% in 2009, which implies that the company has always relied on equity. The equity has increased from 87.4% in 2008 to 94.8% in 2009. Also, the debt equity ratio has decreased from 0.114 to 0.054, which is a good sign. Cash flows from financing activities. Net cash flow in 2010 increased from 268,000 to 527,000, which is a 96.6% increase from 2009. The company has raised money this year by issuing rights shares, which is 965,000. Also, the company repays back its borrowings every year. This year too, the company has repaid back but 2.6 times more money than it previously does. Also, the company repaid back a large amount of long-term financing costs. Cash flows from investing activities. The company has invested heavily on PPE in 2008, whereas this year the company has not invested much in PPE. Cash flow from operating activities. The company has incurred a huge loss this year in spite of investing heavily in PPE in the previous year, 2008, because the cash was used in the operation instead of generating cash from the operation. The net cash outflows in 2010 is 55 millions, whereas on similar lines, the net cash inflow in 2009 was 49 millions. There was a change between outflow and inflow in these 2 years. The company has recently bought PPE in 2009 to increase the future cash inflows. We observed that NOL turned its losses on hedges into gains in 2009. We'll talk about some of the ratios. Current ratio, which is given by current assets by current liabilities, is a direct indicator of the financial health of the company. Current ratio in 2008 for NOL was 2.82, which is good as it is above 2. The current ratio in 2009 was 11. There was a phenomenal increase in the current ratio. The current ratio has increased because the company has reduced its debt from 12.6% to 5.2%. This is a positive sign for NOL as it is less dependent on debt. The other important ratio is the quick ratio, which is given by current assets minus current inventories less prepayments by current liabilities. The quick ratio is equal to the current ratio here because there are no inventories and prepayments. Third is the capitalization ratio, which is given by long-term debt by short-term plus shareholders' equity. The lower the value, the better is the realization of stakeholders' interest in long term. The capitalization ratio has decreased in case of NOL from 2 to 0.2%, which is a good sign. In the year 2009, the company issued rights shares right issues. It is also notable from the treasury stock that in the past, company had bought back shares and they are holding on it till now. Also, due to the heavy investment in PPE, the company is suffering a huge loss of minus 700,000. NOL has indicated continuing losses in 2009 since 2008. Higher operation outflows were mainly due to the decrease in freight rates, lower trade volume, and decreased bunker recovery. Presently, freight rates have stabilized and trended upwards in some trade, which is a good sign. If these conditions continue, better business performance is possible. However, significant risk remains, particularly the sustainability of demand and higher fuel costs in the shipping industry. The group needs to pursue strategies which reflect the current operating environment, including the achievement of cost saving and improved asset utilization, yields and productivity. Thank you.